Hi, everybody. This is Patrick Zielbauer from Infinity. Thanks for listening today. Pretty wild today. It is about 3:40 in the afternoon on the 18th of September. So we just had that Fed announcement, and we had the market fall pretty aggressively after an initial pop, and then rebound all the way to the point where it was making new highs just after the 3:30 open. So quite a day. A day I want to try to I will try to reference a little bit further in the presentation, but the reason I have you here today is I want to talk briefly about the micro E-mini contract. So I put together a little presentation that I'm going to show you here called Micro E-minis, the case for and against. And basically, we've seen a lot of people express interest in these markets since they were released in May. And we believe, and I personally believe, that there is a place for them among futures traders. I think that there's also some misconceptions about how they are best used. I would like to talk a little bit about those. Some of this requires, a bit of introspection on oneself. But let's just kind of go through this, and I'll give you some examples of how I think these can be used properly, and some examples of how I think they should not be used. And then if you have feedback or questions, of course, we welcome that. All right. So why are they popular? Well, have gotten very popular for a couple of reasons. Number one, the minimums are very low, so you can open accounts with less money. We require a minimum of only $1,000 for the micros. That's pretty low for any futures contract of any size. They're 1/10 the size of the regular contracts, and there's this kind of just general notion that it's better than a demo. Okay, so demo has a lot of weaknesses in terms of you're not really trading real money. You have no physiological response to risk. You can't really practice what that feels like. So the micros at least give you, something to feel that you get when you're trading live money. That would be the basic proposition there. I believe that hypothesis has some weaknesses, but we'll touch on those. But these are the general reasons why these contracts have soared in popularity. The other thing to think about too in terms of the volume that these contracts trade, don't forget that these contracts are fungible at the clearing level with the regular E-minis. That means that companies may be incentivized, trading companies, algorithmic trading companies, high frequency companies may be incentivized by the exchanges to actually promote these products or trade them more often, perhaps for reduced fees or other incentives, which they can then lay off the risk on the regular E-minis. So if a firm has a choice to trade, say, 10 micros or one E-mini S&P, they might have a reason to trade the 10 micros, and that actually can sort of inflate the volume that you see on the platform or on your broker's platform. So that's not to say that it's not real volume. If at the end of the day the market is liquid, then it's liquid, and that's great. But I also think that it's important that we understand that the volume that drives these micros is probably not all retail small traders trading one or two micros at a time. There's probably some other forces in play there. Okay, that's the best way I could put it. So in general, though, these contracts have gotten quite popular, and we do get questions about them, quite frequently. What are the risks of using the micros? So there is going to be a dramatic behavioral change between trading the micros and the regular E-minis. There's just no way to get away from that idea. There has grown this sort of idea in the trading community, in the chat rooms and stuff that I've witnessed, that somebody's going to start off with the demo. They're going to trade the micro E-mini S&P, $1.25 a tick, and then they're going to very nimbly jump into the regular E-mini S&P at 10 times the size. Okay, I do not think that that is a correct path. I do agree that for someone who is a more risk averse, that micros might be better if somebody has a capital structure that just doesn't afford them the ability to trade the regular E-minis. It is what it is. If that's the case, that's the case. But this idea that we are going to just jump from a contract that is a buck 25 a tick into a contract that is 12.50 a tick and still behave the same way, I just do not believe that to be true. I think that if you were to draw a spectrum, and on one end you've got demo trading where there's nothing at risk, and then you've got regular E-minis on the other side, which are, a lot of risk, relatively speaking, to the other two choices, then the micro is very, very close to demo trading. and very, very far away from regular E-mini trading. So think about this. Let's say that you were trading the micro E-mini S&P and you're in a trade that got away from you and it's now 20 ticks away from you. Okay, so 20 ticks times $1.25 a tick, that's 25 bucks. So in a regular E-mini, that's 250 bucks. Are you, as a self-directed trader, sitting there in front of your computer, with no coach looking over your shoulder, just kind of in your office or at home or wherever, are you going to stop yourself out of that $25 trade and take the loss? Or are you going to maybe hang on to it for a little bit, maybe average into it, double down once or twice? It's only a micro, maybe add one or two more micros later in the day until that market reverts back to its mean and you're able to bail yourself out of the trade. I think this is a good time for people to be honest with themselves about what they would actually do in that situation. But very few people are going to be able to mimic that ability when they start trading regular E-minis. Right? That doesn't mean that typical futures customer can't generally afford to trade 2 or 3 E-minis at a time. Typically they can, but it does increase the risk, especially in this market that we're seeing right now that is so news driven and very volatile without a lot of notice. So I just think there is a major behavioral difference that sort of smashes this kind of like pipe dream idea about the micros. I think that there's been this echo chamber in our industry. Maybe it's among brokerage companies or educators or whoever, that this is just a natural stepping stone. From what I have seen since these things came out in May, I don't believe that to be true. So do I think that it's better than demo trading in general? Yeah, I think it's better than demo trading. I mean, at least you have something at risk, but at least with a demo, it's not that useful, or at least most people do. There's kind of this danger in the idea that if you think that you're going to be able to nimbly make that transition, that you go live based on that assumption, you can understand why that could actually be even more dangerous to your trading account than going from a demo where that you're not really trading real money and you understand, that it's going to feel very different. All right, so that's what I mean by better than demo, but just think about that a little bit. It's something to consider, and it does require a bit of honesty with yourself, in terms of how your behavior may change. Now, as I mentioned, I do think that there is a proper use to the micro contracts. I think that the scalability of the micros makes them attractive. So you've heard me talk in one of the other videos and maybe some of the prior presentations about MPD lines. I think that there are good arguments to be made that one could gently scale into a position, into like a counter trend style trade based on MPD lines. I'll show an example of it in the next slide. And then maybe, those contracts are peeled off and I use 4 to 48 hours. And the reason I use such a wide range is that with this kind of market, the market can rebound back, in 4 hours just as quickly as it can in 48 hours. That can really happen in any circumstances, any circumstance, but we are seeing a lot of that kind of movement now, right? So if the market reverts back to its mean and you've remained in your position because you've been able to remain with, let's say, hypothetically, a long bias as the market has gone down and picked up your longs, then as the market comes back up, you end up peeling off those trades. That I think is pretty reasonable. I think that's the way that a lot of people would trade if they could afford to trade the regular E-minis. But most people can't, or that in that way. And I think that most people just can't afford to take the risk of trading regular E-minis that way, where they might scale into 5 or 10 E-mini contracts, and not be even in the slightest bit uncomfortable. So someone who trades this way will probably trade less overall. Even though the per unit cost on the micros is more, you're probably going to pay less in overall fees if you trade that way. You're probably going to take less intraday stop outs because you're not getting those, $100 or $200 hits throughout the day. You're in a position that you might be in for a longer time. And you may get to spend less time in front of the screen, especially now we have this mobile charting solution, as you've seen in some of the other presentations, and you'll see it more. So would I argue that the micros are a great tool for someone who wants to trade this way? Yeah, I definitely would. And despite the fact that the per unit cost, like I said, is a little bit higher, if at the end of the day you're spending less in fees total and you're taking less losses on an intraday basis, so what? Who cares? That I think all that matters is the amount that's coming out of your pocket, not to where it's going. So I think that this is a reasonable way to look at the market. I'm going to show you another slide here, that with the title Choppy Range Bound Markets Are Not All Bad. Okay, so this is yesterday, and you basically have this MPD line where that middle white line that you see is the VWAP, okay, the VWAP right here. And then you've got the MPD lines are the red lines, that's maximum permissible deviation. And what that is if you take the day's range, divide it by 2, and add it to the VWAP, that's where you get the upper line. And then if you take the full day's range from high to low, divide it by 2, and subtract it from the VWAP, that's where you get the lower red line down here. Okay? And then the blue lines represent sort of like half of the MPD. So this would be like a quarter of the day's range added or subtracted to or from the VWAP. So the reason I like these, as I mentioned before, is that the lines are not that hit it all that often, and in my opinion, okay, especially on a day that you can deem choppy for a number of reasons, not a lot of volume, no big news coming out, nothing being tweeted, nobody tariffing anybody else or sanctioning anybody, there's just not a lot happening. Then these types of markets can be good for someone who likes to trade with a counter trend fashion. So, if you were to see the market come back down towards that lower MPD line, if you were to scale a micro or two in here, you could be in that position the whole rest of the day. And you could come back at 3 o'clock and, in this hypothetical example, have exited a couple of lot position without ever having taken a ton of risk, either in terms of the market risk or the dollar risk, because the micros are so small. If you want to be a little bit more active, you can also look for these more intraday opportunities. If you're less patient, maybe you have a bigger account, you can afford to scale in a little bit more. You could use these sort of middle levels as well. So if you find a market that doesn't have a lot of conviction, I use down here full MPD breach or approach, meaning it doesn't always have to go right to the line. You can sort of get a feel for how quickly it's approaching it. So full MPD breach or approach in a non-convicted, no news, choppy, low volume market, that's a fading opportunity. That is going to be something that I pretty much continually argue. Okay, if you're a more aggressive type, you could look for the half MPD, which is those blue lines, breaches or approaches for a fading opportunity. So, you know, this is a situation that is a lot easier to see, obviously with the benefit of hindsight. Okay, we're looking at a chart that happened yesterday. Okay, big surprise. But you can look at the way the market is moving in terms of volume. You could look at the disjointedness of one index versus another. For example, if you're looking at, say, the Russell, S&P, NASDAQ, and down, and they're all kind of mishmashed where a couple are up, a couple are down, they're not really moving in lockstep. That can also be a sign that there isn't a ton of conviction in the market. That might be a day where something like this works the best. And so, yeah, if you see opportunities like this is where I think some of those micros can come in handy. Because again, even if you were an aggressive type and you're picking up maybe a contract here or a contract here, you can still afford to take some heat and maybe even add to it down near that lower MPD area, because again, the micros are so small, and that's not a trade that you have to flip out, uh, you know, 30 minutes later. That's a trade where you could put that on. Now you're maybe in 2, 3, 4 micro contracts. Then you come back 3 hours later and you see where the market is, and you're either stopped out or maybe you have a nice runner on your hands, like this example. So this is where I think that the use of the micros could be a good thing. It doesn't encourage heavy trading. It encourages a respect for risk tolerance and a respect for your own risk aversion and capital structure. So only you know your own risk tolerance. Be honest with yourself. Own your weaknesses. Counter trend trading is simply not for everybody. This is not the same as just buying on a mathematical basis to kind of dig your way out. This is you saying, okay, I'm willing to be long or short from here to here. And as long as the market stays within that area, I'm willing to stick with it. And then you can scale your entries based on that. Okay, but don't buy the idea that only trending markets are tradable. Choppy markets are good for certain strategies like this. I hear it all the time in every chat room and my conversations with my customers that it's too choppy, chop fast, chop, chop, chop. So what? The chop fest can be great. It doesn't have to be an obviously trending market. And frankly, a lot of the people who are, looking for only trends, they can't follow them anyway. That's why people like counter trend trading. They can never get in on the trend early. They can't stick with it. They trail a stop too tight. They take themselves out 15 minutes after they get into the trade. Trending markets are hard to trade. All right, so consider that and trade with your capital structure and sanity in mind. Okay, don't get into positions too quickly, too heavily. If you want to discuss, how this might fit into the picture for you, I'd welcome that conversation. Please feel free to comment or message me, and we can talk about some ideas. But hopefully, Infinity can add some value with these sorts of presentations, and I certainly would really love the feedback. And thank you so much for listening to this one. Don't forget as well to tell your buddies, your trading pals about it. And we'll do a lot more with the charting as well. You can see this is one of those MPD indicators as well. I was looking at these a little earlier today. Obviously, we had the news. This is not something you'd probably engage in as FOMC is coming out, but there were some opportunities in that chop fest, so to speak, before the rate cut announcement came out. So something to think about. Thank you for listening. We'll see you in the next video. We appreciate it. You have a great afternoon. Thank you. Bye-bye.